What's up, Radar Gang? Welcome to another Market Radar podcast. Let's kick it off with what we've got going on next week. Wednesday, we've got Fed minutes. Thursday, we've got CPI. Those are the main things that matter. That's what you got to watch out for. Let's take a look at the NASDAQ for the week. We did close the week fairly strong, but keep in mind, the NASDAQ is the only index with a bullish trend. The S&P, the Russell, the Dow, they're all bearish trends. So that's going to pull some weight on the NASDAQ. To really excel and get back up to the highs, we're going to need at least the S&P going bullish trend again. It's still quite a ways away. I mean, obviously, if we get a few days like Friday, we'll get there pretty quick. So it is possible. But as of now, it's not looking good for equities, especially with the moves that we've been seeing in bonds. So let's take a look at ZB. Bonds have just been absolutely tanking for the past week. I know I sound like a broken record, but do not catch this falling knife. Believe it or not, it can go lower. There are other factors in it. We are looking into quite a few things in terms of other countries reshoring their currency, which will push bonds even lower. We'll have some research out there for you guys pretty soon, but just keep in mind, this can go lower. Do not catch the falling knife. Buying bonds now just because they're low, if that's your reasoning, because they're too low, they've already gone down too much, that's a failing trading strategy. Do not do that. We're not buying bonds until we get up to a bullish trend up above Momo, and we have our system in line with that as well, pointing towards deflation. That's the only time we're going to be buying bonds. And as of now, we're not seeing that, especially with the consumer numbers that came out this week. You want to take us into that?
Yeah, so let's start off with the job openings this week. So we saw the job openings completely reverse the decline that occurred over the last 2 months, and we're now back over that 9 million open jobs numbers. So obviously, there's a big resiliency there in the availability of jobs, and they're not declining enough or fast enough. So that's something that we're going to have to watch going forward, and that's just signaling again the labor market is pretty supportive right now, and it's not something that's being overly stressed, right? And then continuing jobless claims are seeing a steady decline, right? So they're actually going down, but we're still up about 30% off the 2022 lows. So again, continuing jobless claims are fading. They're not going up, something that the Fed and everyone would like to ultimately see is the continuing claims rise consistently, indicating that there is an increasing amount of pressure in the labor markets. And that is not happening. Again, that's following the higher than expected job openings. And then obviously everyone knows we had non-farm payrolls come in at 336,000. Okay, that's double the street's forecast. That was insane, right? You can call whatever you want. The probability of there being a downward revision, whatever you want to say. Long story short, big slam this in the morning when it was released in the market's face. Equities immediately dropped. Bond yields immediately ripped. Everyone was pretty much shocked. The response was pretty much on Twitter, it's rigged. Okay, that was everyone's ultimate first line of defense. It's fake, right? We'll see what happens, how that gets revised, and so on and so forth. But ultimately, that is a strong jobs number in the face of where the market was expecting, and it was something that pretty much no one was expecting, right? So that again just shows that the labor market remains resilient in terms of job availability and utilization, right? We saw the unemployment rate come in at 3.8%, which was unchanged from the prior print. Again, this along with non-farm payrolls reiterates the labor market not as stressed as the Fed would like it to be. And obviously, the reason why the Fed is looking for a stressed labor market is the idea that if the labor market remains piping hot, it's going to just eventually roll back into inflationary pressures.
And so this is
Now,
really like building up into this stage 4 of our 4-stage model where the market just keeps getting tighter and tighter, but the Fed isn't seeing that tightness really affect the unemployment rate and
right.
slow the economy. So we're still seeing strong growth, even though everything, the whole environment is getting tighter. And
Right. And
that's
that's
kind
very
of
interesting.
that's gonna like bring them possibly to the point where they over tighten, where they even raise rates thinking they need to go further, and then something snaps and they're over tightened.
Right. So I'd like to reiterate on that in terms of their over tightening capabilities, and that's 100% a possibility. The Fed can easily over tighten. A matter of fact, I think the Fed is already restrictive enough, right, in terms of where they are against break evens, against all the inflation expectations. They are restrictive enough. The long end moving has nothing to do with the Fed's current position in terms of like their ability to rein in the economy. And I'll talk about that in a second. And I want to go over why that is in terms of inflation, right? So if we just briefly touch on inflation expectations, they're down. They're going sideways. We can take a quick look here on 5-year break evens. They're pretty much going nowhere, right? They've gone nowhere over the last year. Meanwhile, bond yields are up quite a bit. And this is primarily driven by this stage three complex of a resurgence of demand, where your stage three is all about pricing in the fact that there is no recession, right? Stage three is the rates up because there's no recession environment. And the reason rates are going up is because demand remains ample. It doesn't mean that inflation is starting. Inflation is coming back. What can happen is inflation can certainly come back if this demand is persistent enough. We haven't seen that persistence yet. And if we take a look at the real average hourly wages, which we didn't get the inflation adjusted version in the last labor report, because to get this inflation adjusted figure, we need to know the CPI value for September, which comes out next week. But we're able to estimate it to a ballpark, right, by using the Cleveland Fed forecast. This will be finalized next week when we get the inflation figure. But long story short here, you can see that at the end of or into the fourth quarter of 2022, right, real wages started to recover on a year-over-year basis. And they actually peaked in what looks to be June of this year. And they've gradually been decreasing pretty much print over print. Now, what this is telling you is that the pricing power of the worker is had this huge push up into positive territory and is fading quite fast. Now, if this goes negative, it's not going to be good, right? Because it's going to signal that the consumer is basically their earnings are deflating, right? They're not keeping up with inflation. So that's not something that anybody in a growing economy wants to see, and most likely that will be somewhat of a stage four contributor. I'm not going to say that's going to be the stage four signal, but it'll be this idea that, remember, when real average hourly wages were this negative in 2022, the market was pricing in a recession, right? The market did not see this coming, right? The market did not see this coming, and it came,
Well,
and
it
everyone was like,
coincides with the bottom as well. So when
to a degree, yeah,
yeah,
yeah.
when these real wages bottomed, that's also when the S&P bottomed.
Right. Now, is that something that's linear that you can go back over time and check? We're not claiming a long-term correlation there. Right? We're not saying like, oh, just because this goes negative, the S&P is going to drop. But that's a good observation. Yes, you're right. The market did matter pretty much recover off the lows of these year-over-year prints. As they shifted higher, the market moved higher as well. But what this is signaling pretty much is that the consumer is still getting chewed out on inflation, right? They're not really making much headwind here. Their companies aren't priced basically, or the overall average hourly wage isn't going up enough keep that growth moving, right? And unless this can hold positive territory, which it is positive now, I don't want to shoot this down and say this is bad. This isn't that bad. It's just it sucks that within less than half a year we're going from over a 1% year over year real wage increase down to less than 0.5%, right? It's not something you want to see. And then if this trend continues, this will go towards zero. So we have to watch this very carefully. Now let's talk about the recession and what's going on in the States and how that basically coincides with the current stage three situation. Remember, stage three, the compound landing framework, there's 4 stages. we're in stage 3 at the moment. So if we take a look at our United States PMI matrix, what this is showing you, it's basically showing you the breakdown between manufacturing and services PMI in the United States. Now, these numbers are reported in on a scale of any on a scale ranging above and below 50. But I reset the scale for the chart to 0, meaning 0 is 50, and the reason for that is because this is a PMI index. Anything above 50 or anything below 50 indicate either expansion or contraction territory. So we don't need to know the exact value. It's very easy to just look at a chart like this and get the idea of what is expanding and what's contracting. And as you can see here, we had this manufacturing contraction here coming into the middle of the year, the beginning of the year. It reverted rather quickly up to 0, but it's back in negative territory. Now we're back up to flat on both manufacturing and services. Services really blew up, but they faded rather quickly. So what you're seeing here is you're not really seeing a drastic recession, right? You're not seeing something that's severely negative. And this goes back to the whole stage 3 concept, right? The economy is not in a recessionary environment in terms of economic activity yet, right? It can certainly get there. And the longer this goes on, right, the more that people are going to start to throw the towel in and say, you know what, maybe a recession is just not part of the cards. And as they do that, they start losing faith in the hard landing. Everyone starts getting baited into this idea of a soft landing. And what ends up happening, simply put, is everyone's positioned for one way, and they disregard all possibilities of the other scenario happening. And then that scenario happens, everyone's caught off guard, right? Retail's not going to time the recession. They never get it. They're always late to the party, and they're the ones always holding the bag for a reason, right? Because they end up buying narratives one way or the other. So I think that the narrative has been bearish for the last year, and it's slowly been and surely been flipping towards people saying, you know what, all dips are buyable, market's going to be fine, no recession. And when that cake's pretty much fully baked, then I think you have a real possibility of a hard landing or stage 4, right? Which is where everyone gets surprised by an economy that eventually slows down from successive tightening, and everyone's going to say, who could have seen it coming? And that's how this pretty much plays out all the time, right? So another good way, obviously, these types of data points are, for those listening, you might be looking at this and saying, it's a little confusing, right? You're looking at PMIs, manufacturing, services, consumer average hourly wages. How can I tie this into something you can watch right away? And my answer to you is just look at real yields. Real yields are the nominals minus break even. Pretty simple. You can look at this chart, and it's bullish trend. It's rip roaring higher, and it's exactly what needs to happen in stage 3. And why this is happening goes back to what I said at the beginning of the podcast, where nominals are going up, bond yields are going up, but inflation expectations are not. And that has to do with the fact that there's no reason that long-term bond yields should be discounted to the Fed funds rate, the current Fed funds rate, if there is no recession. The whole reason you have a yield curve inversion is because there's this idea that the Fed is only temporarily higher and they will have to reduce rates because of a slowdown / recession. If there's less and less belief of a recession, then those long end yields have to go or will go up. And that's what we're seeing happening. In the process, it's not inflationary, or it's not driven by inflation. And therefore, break evens are pretty much unchanged, yet those bond yields are going up and the real yield is expanding. And the reason this is important is real yields expanding are tightening conditions financially for an economy, right? Because all this is doing is attracting more and more and more individuals into the risk-free space of the market, which is the treasury market. The higher this goes, the more baseline risk-free everyone can look at, the higher the baseline risk-free rate after inflation, the less likely someone's going to take risk in something else. Like, for example, if the risk-free inflation-adjusted rate is 2.5% as it is right now, and then you have a REIT that's paying 5%, it may make sense. It may make more sense to buy this 10-year yield at 2.5% inflation adjusted versus that REIT at 5%, because now you have duration, you have liquidity risk, you have all these other risks that are involved with that 5% yield. where this is pretty much risk free. So there's a lot of these dynamics. Obviously, these are all cost benefit analyses that are run and so on and so forth, but you get the point. A higher risk free inflation adjusted yield is going to mean higher hurdles for other companies that are offering yields or investment products. They'll have to basically raise their bars, and everything gets tighter, and costs have to get cut, so on and so forth. So that's how the real yield or a higher real yield does flow through the market. And now, what does this mean for stage three? Stage three means a higher real yield, further tightening financial conditions. So where does stage four come in? Stage four basically is going to happen when real yields fall apart. And real yields falling apart looks something like this, right? You can go back in any of these time periods, 2018, 2019, it'll look something like this. It'll go bearish trend and start fading towards zero. Will it go negative? That's not for us to decide today. But real yields at the highs is not a deflation signal. It is not a risk-off signal. It's not something that happens in risk-off regimes, right? In terms of the bond trade. The reason bonds have been so shitty is because real yields have been tearing in a risk-off environment, right? So everyone's like, wow, risk-off, we need to be long bonds. Problem is, real yields are expanding. And if you know anything, if you follow us, if you know anything about real yields up, bond prices down, and so is the same for gold. Gold prices down. So until we get a top and reversion in real yields, and I'm talking bearish trend, right, for the real bond trade, bearish trend, there's no bond trade. This can pull down and bounce higher. So it's for us, it doesn't make sense, right? It doesn't make sense to chase real yields here. For the basically, when you're buying bonds, you're shorting real yields. So you don't want to short real yields in an environment like this where the economy can just get tighter and tighter and tighter until theoretically something breaks and sends us into stage four. And that duration of things getting tighter and tighter and tighter, it can last a while. And in that case, we don't want to sit here and basically hold through a storm when we can come in right as the storm's unfolded, right? So that's the idea here. And that also means that stage three can last a while, right? Just real yields are an indicator that there's not enough stress on the economy. If there was enough stress on the economy that everything was really slowing, real yields would drop. Because what would happen in this scenario is, remember those break evens I told you guys about earlier? They were going sideways. They would start to go down, but people would start pressing the demand to own, basically pressing the bid to own bonds. And they'd be therefore bringing down the bond yields. As people buy bonds, bond prices go up, bond yields go down. So that difference between the 10-year yield and the break even will start to close as people chase bonds down and inflation expectations don't drop as fast as the bond yields do. And this will go, simply put, if there's fear in the market, the real yield is going lower. Just keep it simple, right?
Yeah, and I think there's a good lesson in this for people trying to trade this. A lot of people are trying to be the hero and time bonds, catch the falling knife, time the recession, because it's bragging rights, you know? Imagine timing the recession. That's awesome. Not many people can do that. Everyone's trying to play the hero, but they don't realize that you still have time. Once something breaks, which inevitably something will break, and we will get that deflation trigger, we will get the hard landing recession, that's inevitable. You have time to trade that. It's not going to be instant. Yeah, you're not going to catch the bottom, time the top or whatever, but you're going to get the meat of the move as long as you stay patient. There's no point in trying to predict the unpredictable. Something will happen. Yeah. We will get more conviction. Right now, there's no conviction. There's no end in sight. We don't know how high real yields can go. We don't know how low bonds can drop. So many factors can happen. But once something breaks and these move, they add conviction to the trade. The risk to reward ratio drastically increases at that point. Especially if you're planning on buying bonds. We are planning on buying bonds once we do get that deflationary trigger and things start to line up. The move that we've seen in bonds to come down to where we are today took 2 years. It's not going to be an instant move up. It's going to take time. Everything takes time. And so a good lesson in this is wait for that conviction. Take the trades when you have that optimal risk to reward. There's more information out there and you're able to go in with conviction. It doesn't matter if you're trying to catch a falling knife right now in bonds and you're so scared because there's no conviction. So you're throwing, you're throwing $1,000 in there. Oh, let's see if it hits. What happens if it hits? You make nothing. We go in with conviction and we go in big with leverage. So there's very minimal room for error there, and that's why we wait for conviction. And that's the way you have to trade. So that's the lesson in this.
I think that's a good lesson because, to your point, yeah, we won't wake up one day and the economy is just destroyed, right? Everything's just done. Long-term bond yields are down off their highs drastically. Real yields are at zero, right? We're not going to just wake up tomorrow. That's not going to be the case, right? So you have to, I think that's a good approach. Spoken about that a lot. Take it day by day, guys. At the end of the day, this is a game of this isn't a game of timing tops and bottoms. This is a game of preservation. The more regimes you can endure as a participant, the more opportunities you have to multiply and compound your capital. Getting wiped out in between, all that does is reset your timeline, right? So you want to make sure that you preserve enough to be around for the next run after run after run. And eventually you've compounded a massive amount of returns. And that's where things get really fun. That's where the FU money comes from, right? You don't get that from buying unless you're doing something with super, right? Like think about it. You're not going to make FU money buying the bottom in bonds. And we'll take TMF for example, right? Let's look at TMF. You're not going to make FU money buying the bottom in bonds here because the reason why you buy the bottom in bonds, there's no difference in why you wouldn't have bought it here, why you wouldn't have bought it here, why you wouldn't have gone in when FinTwit was capitulating here in SVB, right? There's no differentiating identifier here across any of these pushes lower that would have told you this is the time to not buy bonds, right? So to make FU money, you have to go in with huge size, right? So you would have been wiped out in pretty much all of these scenarios. And that's the problem. You need conviction with a double tested system that will keep you out of all these false breakdowns. And if we look back here in bonds in 2022, this looked great. All these higher lows and whatnot, holding up and grinding higher, looking like it's about to go. And sure enough, it didn't. But a lot of people got caught in this area thinking this was it. Bond lows are in. We're going to the moon. And sure enough, the leverage trade printed well below those lows. So you have to be very careful. And back to what I was saying earlier about stage 3, to sum it up, it can go a lot longer than you guys think. And like already said, just because something's down a lot doesn't mean it's down enough, right? And if stage 3 is prolonged, you can see things simple as Bitcoin that have been holding up pretty well start to go up and really try and add to that stage 3 fuel of pricing out the recession, right? Going bullish trend, pushing up higher. And is there a possibility that we get a risk on regime in between all of this? Anything's possible. We keep saying this. Keep your mind open. Narratives sit in the passenger seat. Bitcoin here above 28K starts really pushing odds higher in favor of a bullish trend. And all that will do is basically just give more and more confidence to this idea that the recession isn't here. There's no reason to have fear in equity markets, especially if VIX can bring itself back under like the 16 range and bring itself lower and volatility suppresses. That will really just, again, brew up this idea recession isn't here. And all that does is add more fuel, because what that's going to do is saying a recession isn't here is going to just add more tightening to the economy through financial conditions. And it's only going to make stage 4 worse when it hits. So that's all you guys have to know. Keep everything simple. Follow the tools. The tools will guide you. The tools will give you an overview and basically tell you what to expect, right? We don't expect bullish trends and bearish trends. We don't expect huge price reversals here. We don't expect a trade of a lifetime to come from a bearish trend, right? Same thing for a long, right? Same thing is for a short. You don't expect the shorts to happen in bullish trends, right? You want the shorts to happen with confirmed conviction. But thank you guys so much for listening. If you guys have any questions, feel free to reach out to us on our Twitter at The Market Radar, or you can go to our website and get access to our daily quant reports that include all of our tools and data points. And our website is market-radar.com.